Does it make sense to max fund accumulation-based life insurance sales? 100% of the time. No argument there. 100%, absolutely. However, could it also make sense to increase the death benefit a little bit? I would argue that it does, and here's why. On numerous occasions, I've received phone calls from advisors who have clients that they've sold accumulation-based life insurance to. That could be IUL, VUL, whole life. Now, whole life's a little bit different here, but let's focus on the IUL and VUL pieces of this. They've called me and said, hey, look, my client's been paying $25,000 a year. They got a bonus this year and they want to put a little bit more money into it. Can we run it in for us and see if they can do that? And so I run those in-forces and I look at them and say, hey, look, like you designed this minimum non-max funded policy. You can't put in a nickel more, otherwise you destroy the contract. So what's the option? Well, we could sell them a new contract. We could, except that's a whole new commitment, right? That's a second policy. Now you're committed to this. And we don't know what that income is going to be in the future. See, many of the people that buy accumulation policies, many of the people that should buy accumulation policies have varying incomes, right? They're executives, they're business owners, maybe they're attorneys or doctors, etc. But their income does one of two things. It either A, has bonuses attached to it, or B, it's going to increase over time. And life insurance, unfortunately, is one of those, accumulation vehicles or tools, unlike a brokerage account, which you could just say, hey, look, this year I put in 50, next year I want to put in 100, right? You can't do that with a life insurance policy if you max fund it. So what I did is I ran index universal life and variable universal life, 6% on the IUL, 7% gross on the VUL, and I averaged all of these out. And this is all based on a 45-year-old male, preferred non-smoker, putting in $25,000 a year. No income, okay, and just paying to age 65. And the average death benefit on that was about $386,000. And at age 65, had about $840,000 cash value in it, $850,000 cash value at age 85. Then what I did is I took that death benefit and I increased it by 35%. So that took the death benefit up to about $525,000. Same premium, no additional premium, no bonus premium, nothing, just exactly the same. The difference in cash value at age 65, it went from 840 to 816. That's a 2.8% departure. At age 85, it's a 3% departure. It went from 850 to 825. These are nominal differences, giving the client the opportunity to put more in the future, whether their income increases or, again, they get those bonuses. Now, it does another thing too, is if you're a fan of living benefit riders, chronic, critical, or even some of the ones that you actually pay for, like a true LTC rider, this is going to give them a bigger pool to actually pull from. And the second part of it, it's going to do what life insurance is meant to do, which is pay out in the event that you die. So instead of 386, you're getting that 525. It's a much bigger pool to work from. And again, these are nominal differences. So I would say, yes, you want to max fund policies, but there's a good argument, and I'd suggest showing this to your client saying, hey, look, here's max funded. If you're never going to put a dollar more into this, then I think this is the right strategy for you. However, if you want that flexibility in the future to add a little bit more in, we can look at a slight increase. And really the negative impact on that is again, it's very, very minimal. So if you have any questions on this, feel free to reach out to me, and otherwise have a good day.